Welcome to Heartland Market Talk on the Open Range. It is our last episode for the spring season. We look to return to you this fall. In headlines, well, the Biden administration is not basically trying to get any points with the corn farmers, as they probably do not anticipate winning the state of Iowa in the presidential election, as sustainable aviation fuel standards will not be met by pretty much any corn producers this year. It's hoped under a new administration this fall, possibly in 2025, the GREET programs will have something for them to get carbon indexing to take advantage of the credits for sustainable aviation fuel. Now, on to avian flu. Michigan, the state of Michigan, will be testing workers from dairy farms for avian flu. What's interesting, throughout the United States, only 3 individuals ever contracted some form of an avian flu infection, and all they contracted was pink eye, and they were sent home with a salve to take care of it. One worker had a cough, so in a precautionary note, they gave him an antiviral. But again, there's been no harm to any humans, and no avian flu has gotten to any of the food sources like milk. Milk now is going to be tested for any herds that are planning to be dispersed throughout the country. There are 7 states that have now reported avian flu dairy-affected herds, and so any herds that want to move to other states will now be tested before they'll be allowed to move on bulk transport. Well, OPEC, they will be meeting this weekend. They will continue to talk about their cuts that have been extended from last year into 2024. Recall back in late 2022, OPEC got together, promoted up to 3.6 million barrels a day of oil cuts, which have been carried forward every 6 months and are set to expire this June 30th. While it's a foregone conclusion, they will be extended through the end of 2024, maybe even now into 2025, and a very complex set of rules are being set up for later this year to continue those cuts that could continue well into 2025. Well, in the U.S., though, crude oil stocks were declining. We have our stocks declining this week by some 4 million barrels to 457 million barrels of stocks. But the cause of the declines was the aggressive refining processes heading into Memorial Day weekend, where they thought they were going to need more fuel than needed. And now we had seen our stocks climb for both diesel fuel and gasoline, which prompted further selling again today in the oil complex. Now it's time for Heartland Insights. As we mentioned in crude oil, U.S. demand not quite meeting the mark. We are seeing a softening of trade. And so note, we've been talking about this trend line that the market could not bounce off of like it did prior attempts, as we did a seasonal lift from December into what was an accelerated high in April on the Hamas-Israeli escalation war. And so since then, we've not seen any troubles in the Middle East on production. And so it's been just a grand sell-off here that continues in mass. And here we are into June, past Memorial Day weekend, and our offtake for gasoline was considered poor. So the trend for crude oil looks like it can head even farther here into the month of June and possibly July, as we'd experienced 2 years ago. And here you can see the gasoline chart, that high back in early April. Even today's action, disappointment from today's Department of Energy numbers, sending gasoline to a new 8-week low. The U.S. dollar been strengthening here since late December. Of course, this is tied to the talk that the Federal Reserve is on hold for lowering interest rates. Right now, we're hopeful that something might occur later this year, but recent inflation data is not allowing for that, so the dollar is firming, which of course is part of the reason for the gold market double topping here in April and May. Recall, seasonally, we do see the gold market decline from usually a second quarter top, declining at some point into the month of August before reverting to some kind of buying action if there's a friendly atmosphere for the gold market. And that friendly atmosphere would be the Federal Reserve finally acknowledging later on, maybe this summer, they will do some interest rate cuts as we get towards the election year. Now, we want to take a look at August live cattle. The cattle market has seen a recovery now as of late. Of course, avian flu scares is what set this market down into April. And as this recovery occurs, we are coming back to what we call a downtrend line off of last September's highs, met with the February, March highs, and so the market is attempting to try to overtake this on live cattle. Unfortunately, the August live cattle contract is usually your weakest contract of the year. It reflects the summer demand, which usually by late summer gives way to brats, chicken thigh grilling, basically hamburgers, the lower priced meats, as steaks being grilled usually on Memorial Day and Father's Day weekends, and then after that it tails off. So the cattle market looking to run into some trouble up here. Of course, at heartlandinvest.com, we do sell not only options to protect your herd numbers, we also sell the livestock risk protection. So we're able to do both. options, or insurance, and we can tell you what benefits your operation. This includes feeder cattle. Notice the April lows are now finding its way back to testing this trend line resistance. Now, whether it goes through or not, we'll see. We could have a weak corn market this summer that helps support the August feeder cattle contract, but then if August live cattle are weak, that does not really have an effect on August feeder cattle because August feeders are traded against the December and February live cattle contracts as they are harvested at that time at a full heavy weight. Now, in regards to August feeder cattle, we did note the resistance on the upside, but how about the upward trending motion from the lows from last fall are also relevant as a weakening corn market will help feeders maybe push through this technical resistance. Kansas City wheat peaking early in the week on, of course, the Russian weather talk, which is becoming old now as we've seen a substantial reduction in their crop potential. Rains are expected to arrive next week for the Russian crop, but with harvest some 2 weeks away in the south, it's unlikely to help that crop much anymore. So now it's a matter of will end users step in and support this market. We do have harvest hitting Kansas City in a couple of weeks, so there's more of a concern that we will have not a famine, but more of the full flush supplies of new crop. And we're seeing that as Kansas City wheat peaked at a Fibonacci retracement point here on the charts from last summer's highs at the 50% mark. And now it's time for the question of the day. We had a viewer ask, what is basis grade when they hear about futures contracts? Well, basis grade is the difference between the locations from away from where the futures markets are developed. We have like North Dakota is 600 miles away in some areas from Duluth, where the area for deliveries are for grain. And so there's a basis difference in regards to location and what it takes to get it to the deliverable point. We also have basis grade when it comes to like vomitoxin measuring, or if there's protein grade differences. It's what we do to make everything even for what the contract is specified for delivery at a certain location. So that's why we have basis grade for the futures contracts. Remember, you can always call us at 701-222-0221 or visit us online at heartlandinvest.com. While you're there, don't forget to check out our Heartland Market Talk podcast and sign up for our daily newsletter. And for producers, remember, we offer crop and LRP insurance as well. Thank you for watching Heartland Market Talk during the winter and spring season here on the Open Range. Remember, you can always get all the information you need at our website, heartlandinvest.com. We hope to see you again this fall on the Open Range.